Welcome to Zen and the Art of Real Estate Investing, one of the fastest growing real estate investing podcasts in the world. What if you could learn from experienced real estate investors? Find out what got them to where they are now. Get insight into their daily habits and take these insights to inspire your own growth. Each episode, Jonathan Greene shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor and the founder of Streamline, a data-driven, investor-friendly, independent real estate brokerage located in Madison, New Jersey. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, this is the free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for showing up for another episode of Zen and the Art of Real Estate Investing. My guest today is Scott Lurie, and now we're talking real estate and investments for the alternative investor. That's at his company F Street, but we're also talking hard money at the Hard Money Co., and we go all the way back and start with just your regular ugly houses right now. Let's go. This is episode 293 of Zen and the Art of Real Estate Investing with my guest, Scott Lurie. Scott is the founder and owner of F Street Investments, a hard money lender, a longtime real estate investor, now focused in multifamily and industrial. He also has plenty of experience in private equity, property management as well. Scott, welcome to the show.
Great to be with you. Thanks for having me.
Yeah, I'm excited to talk to you because you have a breadth of experience, and I like hearing from people who've been through all aspects of the game. Which part of real estate did you start in first and why?
I started in real estate in August of 2003. If you can believe that, I had zero experience. I became the first franchisee in the state of Wisconsin with the We Buy Ugly Houses franchise. So I bought my first franchise. I thought real estate had the keys to what I was hoping for, which was independent wealth and cash flow. And so I bought my franchise in August of 2003 without a single piece of real estate or experience in my background. My family's owned no real estate, but I wanted to be involved in real estate and started flipping houses and wholesaling when wholesaling was a different version of it than it is today.
Yeah, I mean, it was much easier back in 2003, right? I mean, it was kind of like, really, it was We Buy Ugly Houses. That's what it was. And now it's become much more nuanced. But did you read Rich Dad, Poor Dad, or what led you to think that real estate was going to be part of the thing that could help you develop something that turned into generational wealth?
Yeah, I lived a middle-class upbringing with my family. We were members of a local private country club. I know that might sound more elitist than it simply was. A place of middle class people would congregate. There were some wealthy folks there, and all of them had the same parallel back to real estate. And I said, growing up in a middle class family where my family was in their own family business and hearing the different discrepancies on fighting about money, I said, man, maybe those wealthy people the real estate guys aren't always talking about money. Maybe we should take a jump into that segment.
Yeah. So when you started, I mean, obviously that franchise has become huge, but when you started, there probably wasn't as many. What was it like in terms of 2003 marketing? Because now, they're punching up all the PPC and all of that stuff. But back then it was probably more old school, postcards and things like that. And then a lot of face-to-face relationship building, I assume.
Yeah, driving for dollars was a real thing back then. We did a lot of billboard advertising. We did tons of mailers, 10,000 a week.
Yeah.
And we were really, as you think about, today versus then, you can call 10,000 people in a minute here in today's world. And back then I would send 10,000 postcards and hope to get 10 calls. But it was less competitive at the time. People were calling that had, motivated seller issues, estates, probates, ugly houses, financial problems, you name it. And I had the opportunity to really meet a lot of great people. And then the referral network starts. If you, nose down, grinding 24 hours a day because I wanted to be successful. It kind of was a different world than it is today. And it was certainly an unbelievable experience.
Yeah. Did you find that because you were local and all the people you were talking about were local, it really helped you build that kind of reputational I guess, cachet, because now so many people are doing it virtual all over the country. But when you're there and you meet the people, they're more likely to refer you to someone else. And then that's the daisy chain that grows how you can start a real big business.
Yeah, I mean, every time my phone rang, you called 1-800-44-BUYER, I answered the phone.
Yeah.
And I'd say, hey, it's Scott. And then Scott, me, would show up at their house to inspect the home. And then Scott would write the contract. And then Scott would show up at the closing table. And those days are changed. I mean, now it's all done, remotely from a guy in Arizona who's buying a house in Milwaukee, who's wholesaling it to a guy in Charlotte. The world's changed. But for sure, I mean, the network and the ability to talk to that real estate and, person, whether it was an investor or a probate. And then, believe it or not, somebody who's in probate or somebody had a probate case knows another person in probate, and, generations kind of moved together, and the referral source was unbelievable.
Yeah. Before we get to where you went from there, I just want to touch on it because you're still in Milwaukee, right?
Yeah. Born and raised in Milwaukee and still in Milwaukee.
Awesome. And it's, a great market. But so, because you were saying just this random person from Arizona that is calling in Milwaukee now, don't you think that the local Milwaukee investor still has an advantage over those people who don't really know what block they're on? Of course, the price investors who just want whatever someone's going to throw at them, yes. But I've always found that local, you still get it because you're like, oh, I sold 2 houses on your block. Do you know John and Steve? And they're like, oh, yeah, we know them.
Yeah, local always wins. The problem, as you alluded to in that sentence, was, price, right? And so I can go in there and give someone a real value of what a real ARV is, what the real repairs are for the house, because I've actually done the work, right? I walked through the property, I did my own comps, I drove the comp set, I drove the neighborhood, I did all of that work, right? And now what people are doing is they're pretending to drive a neighborhood, but they're not. They're looking at Google Maps, which they're not. They're writing an offer because Mr. Smith or Mrs. Smith said, I need $85,000, and I offered him $65,000. And what ended up happening during that process really was the validation, because that wholesaler would then say, I'm going to go try to sell it for 100. They can't sell it, and then they disappear, right? What has ruined the reputation of the industry is they've disappeared. So when they went to close, the moving truck's in the driveway and they're saying, we're ready to close. And the wholesaler, the buyer from Arizona, is nowhere to be found. Then they call Scott, and Scott's back in the mix, ready to go.
Yeah. And that's exactly what I was going to, because I think when you started We Buy Ugly Houses or that type of business, it's a local home buying franchise where, because you get good at it, then you have overage. So you wholesale some. Now people have, businessized wholesaling and ruined it, because they're not local. So they're just, they just don't know the streets. And I think that's a big difference, don't you?
Massive difference. And you can't replace being a local real estate investor where you can touch and kick the tires. And that's a real thing. And it means a lot to us. And we really buy and do work in our neighborhoods where we can be part of it and or be able to get to them. So I 100% agree with you. And I certainly have my opinions on the nationwide wholesalers that are causing for regulation to be implemented due to the consumer, the seller, ultimately getting harmed.
Yeah, it's definitely a long ride. But I know you do multifamily as well. We'll kind of bridge the gap between them. But is your multifamily portfolio, is it all in Milwaukee, or are you all over the place now with F Street?
Yeah, so we're a nationwide multifamily holder. We have investments in multiple states. We build only right now in our backyard. So we build multifamily in southeastern Wisconsin, and we buy multifamily around the country. So we've done some creative work related to conversion from hotel, Generation 1 residence inns into multifamily dwelling units. And we've done that at 6 different sites throughout the country, Texas and Mississippi and Ohio and New York. And we've had great success in that space. But we really focus on the southeastern Wisconsin for the build category.
Yeah, that hotel to multifamily conversion is great, because I think people think like, oh, well, there's all this retail space, but retail doesn't convert because the plumbing and the windows, everything's in the wrong space. But hotels, especially if you're doing what you're probably saying, residence in, they have little kitchens, everything's there. You really have the plumbing and electric in the spots where you don't have to overspend when you're doing a renovation.
Yeah, I mean, that conversion is a perfect case study versus, replacement cost conversation versus building and what additional marginal rent you can get related to class B or B plus down to the class A, right? And, when you get into replacement costs, we can be all into these units for Our lowest one was 35,000 a door in 2015. That was our first one we did. And it elevated and ballooned to about 70,000 a door in call it 2021.
Yeah.
And then it seems like everybody found that recipe and started doing it, but then pushed prices into the 80s and 90s. And it's probably not worth it at those values per door. And so you get into that discrepancy of, what can you charge for rent and what can you achieve for rent? And then what's the value cost or value proposition play? And we've done pretty well in that category.
Yeah. Are those, I guess the neighborhood differentials are different. If you're doing new build, everybody is new building in Class A neighborhoods. Or is that what you're doing?
Yeah, so we do new build. Our widget's a little different. So in southeastern Wisconsin, we build in suburban markets where we can obtain tax incremental financing from the municipalities. That's the only way that we have been able to get a pro forma to make sense. And so we work really hard with the communities to obtain the TIF financing or the tax incremental financing to allow us to make sense of the numbers and deliver marketable returns to investors.
Yeah, but so when you're buying though out of state and you're rehabbing assets, are you choosing neighborhoods that are, B's or C's and trying to upgrade them? Maybe they're on the curve of where those neighborhoods break, because that can help you scale up as well as your renovation. You can kind of get a double push then.
Yeah, I'm not sure who the real estate department was at Marriott in the late 80s, but they were pretty good, right? And if you look at what happened, the residence inns, the generation ones that we converted, right? So all of those had individual doors, entrances, egresses, and they all had individual bathrooms and kitchens in each unit. They've all phased those out. So that type of product for residence inn is gone, right? They deflagged all of them and they've converted them. The interesting part is that they've rebuilt almost all of their residence inns within 3 miles of the existing generation one residence inns. So if you go find a residence inn, there's another one right down the street, the old one and the new one. And what that really means is for us is that the residence inn flag is one of the most well-respected, well-repeated visitors of hotels, right? They get the highest ADRs and they get the most allegiance to that brand. And so they're making these in really well-to-do or well-received communities.
Yeah.
And we're just piggybacking on some very smart guy in the late 80s real estate strategy under the Marriott brand.
Yeah, I mean, especially knowing that they did it back then in the late 80s and now they're going 3 blocks away. Like it's obviously gone well.
Right. Something's going right. We want to be here. So it's worked out quite well for us.
Yeah, but what you're talking about really tells me so much about what it takes to be a long-time real estate investor. Do you feel like when things got really hot and you kind of put out this formula that especially pandemic and a little beyond, a lot of inexperienced operators got into the game, especially in multifamily, that kind of muddled it up for a lot of people because they didn't understand these things that you're saying now, got themselves in deals that weren't going to turn out the way that they thought?
Yeah, well, 100%. The problem is the pain hasn't really started yet, right? We're entering into what I would describe as in the next 18 months is going to be material pain for those investors. And I don't know who gets harmed, right? At the end of the day, there are a lot of people that have either got into this business and went full steam ahead and are buying or building so many units and they forecasted a low 5 cap rate and the interest rate in the low 4s or wherever. Right. And we're nowhere near that number. Right. And so, and I don't know if we ever will be right, in the immediate, call it 5 years. So what happens if you can't achieve more rents, which people are trying to do, and you have to make concessions because the world's getting, call it all those have come online now. Yes, there'll be a delay in supply over the next couple of years. We're going to see a massive erosion of equity, or banks that are going to be looking for loans to get right-sized to meet debt service coverage ratios or any covenants. And that's going to be a really interesting time here. You're going to see a lot, I think, not predicting, but projecting that the future is going to have a lot of really nice Class A multifamily units that are overlevered and unsustainable in terms of banking, right?
Yeah.
Can they make their cash flow? Sure. But what happens is the bank forces the hand, right? They say pay, and they can't pay, right? The investor doesn't have the $4 million to right size, or if they have 10 projects, $40 million to right size their loans, and they end up in default. Now, banks are not prepared to default loans right now. because they don't want the world to come down. So everyone's kind of playing nice in the sandbox, but that's going to change, right? Liquidity is an issue. Banking is an issue. People are concerned about what's actually happening. Some mergers are happening between banks and maybe some acquisitions. And, when the new sheriff's in town, I don't know if I want to be caught holding those bags.
Yeah, that exactly. I mean, I think we've seen signs of it, but I agree with you completely. I've had a lot of guests on the show who agree the same, that there's going to be some interesting things. And it really depends on how the banks want to play it, what's working for them at the time, because they can give, and give. But at some point, once they start calling things due, there's going to be a lot of people, as you said, who were hoping that when their 5-year loan ended, they were going to be at 4, and now they're at 7 still.
Right. And that, what I tell our investors, we're a syndicating group, so we syndicate to hundreds of investors. I said, people, it might sound small, 3%, right? But at the end of the day, a 200 basis point or 100 basis point, 70 basis points is so material on a $50 million loan package that it throws everything into a tailspin. And when that happens, I hope people are prepared and have saved and have an action plan to resolve it, because I do see that there's going to be material issues in the marketplace.
Yeah. I wanted to connect the dots between your original first story of how you got in with We Buy Ugly Houses and then syndications, because probably, to me, what I've learned now being an LP and 4 multifamily deals is relationships are so important. Who you know, how you work with the operator. Do you think that your experience one-on-one with all of these home buyers in the beginning helped you kind of with that relationship building, that when you got to raising money for larger syndications, it made it a little bit easier? Because it's always tough when you start asking for big checks.
Yeah, it sure is, right? I mean, you go out and we're in the middle of an $11 million raise right now. We're 80% through it. We're finishing up the push here in October. I remember the day I had to ask someone for 50 grand. I remember the trembles in my body saying, I got to get 50 grand to go do this deal, right? $50,000. $50,000 is a lot of money, whether it's from Grandma Smith, who worked her lifetime to create that income and now wants, or that savings, and now is going to invest it with me. I have a different approach to that, right? I really believe it's a function of the cloth of the characters you're investing with, right? I think it's so important that high integrity people who understand and plan are really the people that I like to invest with as LPs. I'm in an LP. I do invest with other people. So I do that for diversification, but I also really evaluate those people. And I ask people to evaluate us as a syndicator, right? What's your track record, right? We have flawless in our hard money lending business. We have 16 plus years of flawless payment record to our investors, over $5 million a year, right? I share that with you because it's not easy, right? There are days that you have a bad day, but there is never a day where my investors are not number one to me. And that to me is what really is paramount, right? Because I see what happens, right? We lend money to 500 and some loans a year. I see what happens. But when somebody has a little bit of success, right? As a case of an example for you, we had a guy who built a house. He did really well. He made 250 grand. And guess what the next move he did with that 250 grand? He bought a Lamborghini, right? And the cost of the character is to buy a depreciating asset that's not going to get anywhere. So long story short, his next loan, he ended up being foreclosed on because he couldn't finish out the property, right? So fast forward, like as an LP, I'm a syndicator. I hope you hold me in the highest regard of requirements to take your hard-earned money and be an investor of mine. And so that's kind of how we frame it here. We're disciplined. You have to be disciplined. We want to be disciplined GPs, and we really hope that when an LP evaluates us, that they do it with material energy and effort. I do see all the time people are like, "Oh yeah, here's 50 grand." I'm like, that's weird. Would you just throw that to somebody else down the street? No, but people do it all the time, and I always want people to stop and pause and say, "There's an opportunity to get hurt here. Please evaluate it so you don't get hurt."
Yeah, I think that's especially important in syndications just because people now think of it as true. Of course, it is passive, but also like there's risk involved in everything with real estate. And we found out really quickly that inexperienced operators can really bungle up the syndication game. So I think it's really nice that you can say like, yeah, check us out, because we always hear in the syndication world, trust the jockey. And it's really true. I've bet a lot of mine on the people who are operating. I look at the assets, but if I like the operator and the asset, pro forma, everything looks good, I'm banking, especially once you have one that goes well, then you're just looking at repeat customers.
And that's right. And you got to make sure that you can get the feet in the door, you can deliver, and then you can repeat. And that's how we look at our opportunity, right? I'm not as good as I did yesterday. I'm only as good as I'm going to do tomorrow. And I got to continue to perform. And it's a 24/7 work day for us here to make sure that we can deliver on that.
Yeah, and it's interesting though, because you tied them together with your hard money business, which you've been at for so long. But like the volume of hard money and what people are doing, it's really tough because it seems like everybody wants hard money, but not everybody knows what to do with it, as you're saying for a Lamborghini guy. So how do you decide on the hard money side of the game, like who's worth the risk? Is it based on the asset, or are you also looking at the person and saying like, can we really trust them? Do we want to give them a chance?
Yeah, it's all of that. I mean, I would say to you would be amazed, and then I realized you're sophisticated enough that you wouldn't be amazed, but you should be amazed. So we close 7 to 9% of our loan applications that come in. That's it. Yeah. We're getting 400 to 500 loan applications a month. Wow. We're deploying, call it 15 to $20 million a month of new capital on the streets. We're denying 93% of the loans. Call it 92% of the loans. People go back to late night television, if you remember that one. That was when you could learn how to flip real estate, and then go to the internet and YouTube that's out there right now. People, the barrier to entry into real estate and then ultimately getting a hard money loan is at probably an all-time low, right? You don't have to do much to get into real estate, and you probably can get some money somewhere if you do enough digging, right?
Yeah, for 17%.
What people forget, but what people forget about is, I always tell people, what you should be using our money for is to make money. We're a widget, right? We're just part of that cost of goods on the production floor, or we're a lender on, we're a supplier into your manufacturing space. We're just a widget, one part of that widget. That's all we're doing. And so I always encourage people, I'm like, go and make money, go and be successful. 95% of the people do. Right. Yeah. And then you have the people, which are my favorite ones, all of the ones that are mentoring people out there on how to be real estate investors are all being foreclosed on by me. I've got 4 coaches that have wholesale classes and real estate classes, and they're all in default and being foreclosed on. I said, did you guys look these people up? You're investing $10,000 in his wholesale class and he's doing really well. He's being foreclosed on.
Yeah.
Like that's the crazy part of our society today is if you have a personality and if you have a little bit of, pizzazz, you're out there, wholesaling coaching and you're a coach, but what are you coaching them on, right? You got to coach them on how to be successful.
Yeah, it's unbelievable because I grew up with a dad who was an investor and we were hitting the streets, for literally when I was 2 years old. So, 52 years ago, and there was no internet, all there was Carlton Sheets, like you said, 2 a.m. programs where you can order tapes. And we just talk to people. And that's how I learned to be good. But I tell people now, stay off of TikTok and just talk to people. If you're good at relationships, you'll be good at real estate. And to your point, if you're going to take hard money, you still need to be good with people, because the way you're going to get the best deals, as you would start, like how you started, is being good with people, or else you're just going to offer, something high, pay some wholesaler a 50,000 spread that's not worth it. And then you're going to think your renovation budget, is 50 grand and it's 120. And here you come calling like, hey, you guys are idiots.
Yeah, and we that recipe, that little sugar with that little salt, it happens so often because, people, like anything, people are lazy, right? Yeah. They want to work, they want to make the money, but they don't want to work hard for it. I tell people all the time, one of our number one things is, how hard are you willing to work to make 50 grand? And if the answer is I'm willing to work 80 hours, go do it. Measure twice, cut once. Go do the rehab work. Go look at the rehab work. Don't just give money to a contractor and expect him to show up the next day. He's not coming back once he has your money. Do a background check on these guys. Make sure that you know what you're getting into. Make sure you understand what's happening. make sure you're not paying a $50,000 wholesale fee when you can go get your own for the $50,000 you saved. Just go work a little harder.
Yeah. Write some letters. Yeah, I do. I think the work ethic problem is huge, especially with the FIRE movement, because I was an attorney. I started my first job as an attorney was for 25 grand as a government prosecutor. And I was working 100 hours a week because I was obsessed. And I took that and put it into everything I do. And I think now it's like the opposite. How can I work hours a week and make 125 grand? When look, you got to grind out to be good at something. It's like they've never read Tipping Point or something on how to get good at your craft. Hey, it's Jonathan. I hope you're enjoying this episode with Scott Lurie. And if you're looking for cash for your real estate investment property, you may have found the right place in this episode. Go to thehardmoneyco.com. They've got funding options for any experienced level investor to get their project started. You're going to hear about it on this episode, and you can learn more about it by going to thehardmoneyco.com. Let's get back to Scott.
I 100% agree with you. I mean, I always encourage people, the people that are defaulting, the people that are filing bankruptcies by bad advice are just lost souls that'll end up right where they belong, with broke and in the corner. And for us, we'll just make sure we weed them out and move on. So it's a sad existence because a lot of people get really bad advice and take advice from people that don't even know what they're talking about. So it's like, oh, you trust that person based on what's their experience to gain the trust you've offered, and don't ask the tough questions. We love to ask the tough questions.
Yeah, it's because they have a Lamborghini on TikTok that's leased. Yeah, I mean,
right.
Great.
Green one.
Yeah. What gets people into that 8% of accepted hard money loans for you guys?
So it all starts with the application. I mean, at the end of the day, we're an internet base, so we do a lot of local loans here in Milwaukee. We also do a lot of loans. We're everywhere, right? So we closed in 12 states this month so far. What happened? It all starts with the application. So a good application that makes sense, that's well written, that's well articulated, that has all the attachments, that's well crafted, is the great starting point for us. People don't understand that when you've worked hard, credit score is an important thing. I tell people all the time, you don't realize the implications of your credit score, but it's a number that we rate you on, and we don't even know you. So when you say, well, it has nothing to do with anything. The only thing we know about is it's a number. And if it starts with a 5, you've worked really hard to get there, right? Meaning you have worked really hard to not pay your bills. If it starts with a 7, you've done a really good job to be financially responsible. We want to talk to you. Yeah. And so it starts there. It starts with an application. It starts with a credit score. Then it starts with a business plan. Then it starts with the comparables. Here's my business plan. I'm going to buy this property. It's worth X. We've had millions of dollars of disparity between what you think the ARV is or the after repair value is and what we say it is.
Yeah.
You can't be that off. And we're not off. We're pretty good. So, you have a lot of those pie in the skies or bad information that people are being offered. But at the end of the day, it starts with the application. Then it starts with the phone call, right? We get an application. We'll be on the phone with you within 3 minutes. We're going to ask you some great questions. If you have good answers for us, we'd love to talk to you. We then look at your background, right? If you've got foreclosures, if you've got evictions, if you've got money judgment, if you're not paying your bills, you're just going all the way down here until you finally get thrown out as a rejection. And if you're doing the opposite, you're paying your bills, you're working hard, you've got great experience, or you're working hard to get good experience, we want to talk to you. We want to fund your transaction.
Yeah, I mean, just from that description, I can see why it is actually easy to get it down to 8% pretty quickly, because it's just like people are trying to get money, Peter to pay Paul, that type of situation. I've seen it in the flipping game all the time. You look at these half-done flips and you're like, what were you doing? They're getting, oh, well, I have a hard money loan at, 22%. I can't complete this. It's like, well, why were you at 22%? Because your credit's, 520 and you've done this before. So it is a slippery slope, but that's really important though. When you started the hard money business, were you just as choosy, or did you have to figure it out? Because I always ask the same questions for syndications too, and it applies. It's like you need the money in the beginning, but you still, if you don't start off choosy, you can end your whole business really quick.
It's interesting. We have a lot of repeat customers, right? So we fund about 50% of our loans that go to repeat customers, right? So we try to improve that number each month. There's a very interesting correlation between the repeat customers that are successful and what they do versus what the unsuccessful people do and the excuses and nonsense, right? If you pull those together as just parallels, right? And you said like, hey, what is the successful attributes? Well, professionalism, respectful to time, working hard, no excuses, always makes their payments on time, and values the relationship, right? That happens every single time. And those people are doing 5 to 20 deals with us a year, and they're making rough numbers, $35,000 to $50,000 a flip, right? Yeah. So some guys are making $300 to $1 million a year, right? Let's just say that is the thing. And they never complain. I never hear from them. I only know they're repeat customers because I have to sign their satisfactions to satisfy my mortgage. And I can see the day it was issued, the day it was returned, right? And so that's there. The ones that are going the opposite sides, the ones that are in foreclosure that ultimately end up in some form of ridiculous bankruptcy that ultimately gets dismissed because they can't put, the pencil to the paper and understand even what they're filing. They're just delaying what? I don't even know what it is, right? So you go down this category. They all have the same characteristics, right? All of them. And it's excuses. I'm the problem, not you, all of the nonsense. And those people will never be successful, whether they're in this business, real estate, or any business. And the people that are over here that are successful could be successful in real estate or other businesses, right? They just get it, right? They get how to win. And as we say, winners win, and they're doing a good job winning, and we're proud to support them.
Yeah, and it's just another indication of the trust buildup that you have. So then when you have someone who's coming back for the 9th time and they send in their sheet, you're still going to look at it, but you're like, well, they keep crushing it. You look at it and you already know, like, you can match it up quickly. Their numbers are going to be good. They've never been off on their projections. Their ARV is correct. Their repair costs look good. That just means like, hey, we can just keep doing this over and over. You don't have to worry as much about them as a new person, even if they've done a good job.
100%. And those loans, that repeat loan closes faster with no friction and with less pay, and then they might have some nuance that they want us to work on, whether it's a little higher leverage or something. It's an auto approval, right? It's, hey, the biggest indicator of your success is you working with me and repaying us, approved. Yeah. And it's so fast, it's so efficient, it's so smooth that all of a sudden they're like, oh, I can do this now a few more times. And they generally, in the high 90s, continue to be successful.
Yeah, I think there was a misnomer out there that for hard money lenders, it's exciting when people, drop the ball and you have to foreclose, but it's the biggest pain. I mean, you get money plus the property back, but it's such a pain, especially to do at scale, right? It's not like you look forward to foreclosing on someone because that's a bad business model too.
I don't even know how that came about. That had to be some person who's losing their home for non-payment that said this person's looking to foreclose on me, and they call it lend to own.
Yeah.
I will tell you, as a lender, every time I have to say foreclose, there's implications to my decision, right? It affects their credit. It affects their future. It affects their ability to borrow. It affects their ability for future opportunities. It has a 7-year implication. Then if you add on to that another small fraction of those subset file bankruptcy, which then adds another sublayer of problems, right? Because they all file a Chapter 13 or a Chapter 11. They'll all get dismissed because 99.9% of the bankruptcies get dismissed because either the party can't fulfill the obligation or doesn't file correctly. But assume all of that happens. We don't want to file. We want to lend and be repaid. There is not a lender in the world that wants to lend money to own and deal with the aggravation. There's a lot of other ways to be aggravated and stub your toe. And they'll do that versus lending you money, creating a relationship, hoping you don't pay, and then filing foreclosure. That's not how any lending business gets situated and how anyone's set up to operate.
It's why those first set of clients that you're talking about, the repeat, they do the same thing, they close on time, and then they just do it again because you're going to do way more deals with them instead of hanging one up for 19 months on a balloon after their 12 month has run out because they didn't know what they're doing, got 2 red cards. It just makes sense.
Of course. And we always work with people. Listen, if someone's got a problem, which happens, right? You call me, you say, or you call me and say, hey, I want to talk to you. What most people do, right? That subset also has this like head in the sand mentality, right? I'm in trouble. What should I do? Oh, just pop my head in the sand. And hopefully when I wake back up, everything will be fine. It's not really how it works. That's not what we would encourage.
Yeah, and that doesn't go to the relationships, open communication, and being like partners in the transaction. Too many people don't think of it that way. But like, yeah, you're giving them money. You're also invested kind of in the back end in the project because that has to turn out right. The ARV has to be correct. So I think of everything in real estate as a partnership, and I think too few people look at it because they think that partnership is like this. Oh, well, we're stuck together. It's like, well, you need me, I need you. Let's make it work.
Yeah, and it's good for everybody.
Yeah.
You know what? It's good to have good partners. I always say I've got hundreds of great partners, and I am respectful to them, and I value them, and I treat them with the utmost respect, and I do everything I can to make sure that they are taken care of.
Yeah. Where do you think I guess, where's the spot where people are going wrong the most when they're taking hard money? Because obviously it's a higher percentage. Is it even the ones that, like you've obviously they're in the 8%, but if they get into the 8%, they've already eclipsed a lot. And then still there's some subset that fails. What's the main thing that gets them off track other than the characteristics of them? I mean, deal wise.
Yeah, I mean, I think that's a really fascinating question that I'm trying to actually uncover myself. We're trying to figure out if they search the same internet, so if they do the same. So I literally, we have a data analyst that's now working on that for us right now, full time at our offices, because I'm trying to understand that characteristic in the attempts to avoid them, right? Just to be 100% candid about it. Most of these parties, I think, just fail at fundamental life, right? I think that they struggle to wake up every day. I think they struggle to get through the day. I think they struggle. And I think if you went back to like the correlation of where these parties go wrong, it's not real estate investing. It's how they learned, how they were educated, right? How did they learn how to do math? Did they attend or did they work hard when they were a kid? You were on the streets with your dad when you were 2 years old doing deals. They were doing what? Playing video games till they're 24 and realized one day they had to get up and do something. I don't know that. My conclusion is they probably all carry a very similar disposition, right? That disposition has to be some flaws that are blaming others for their weaknesses, being short-sighted in terms of how much money they need, inability to save money. I can tell you that the people that we're foreclosing on have discretionary dollars. They just have chose to spend on other things.
Yeah,
right?
That's a good point. Yeah.
Because I do a background check on them. I've asset verified. I know how much money they have.
Right.
I see their bank statements, right? So when you go back and look at some of them and you're like, oh, you eat out 4 meals a day? Like, that might be a problem, right? Or you have a spending problem, right? I always look at, you could tell. I just saw Antonio Brown. I don't know if you remember who he is, but he was a football player for Tampa Bay.
Yeah, of course.
So he earned $100 million and filed bankruptcy today. Okay, now he didn't have an earning problem, right? He didn't have a problem producing. He had a spending or saving problem, right?
Yeah.
So he, $100 million guy, should be worth $100 million, maybe at this point, with savings and earnings and appreciation over the years.
Yeah.
But instead, he ran into the problem, right? And I don't know if that's an education problem. I don't know if that's a spending problem. But there's some correlation that's very scientific that'd be very fascinating to understand. But I consider those parties all having the same issues, right? And the blame is going to be on me, right? You're the problem. I'm like, well, how did I spend your money? I didn't. So I see there's a lot of correlation. It's easier to flip that around and say, what do I see is very successful in people, right? And those successful people are really good communicators, well organized, no excuses, run through a wall to be successful. And if they're having problems, they raise their hand and come and talk to people, right?
Yeah.
And those core characteristics are really important to us and the large demographic, which is the successful 92 percenters.
Yeah. I mean, I think that's great advice. It's a roadmap for people who want to get started to do it the right way and be transparent about it. I always feel like if everyone was just fully transparent, I mean, life would just be a lot easier for me because I just like transparency. I have no filter. I just say what I want. And people are like, oh, that's so honest. I'm like, what's so honest? It's just honest. It's all it can be. But I mean, with all your years in real estate, I'm sure you've come across things where you're like, how are they like, it's not true. So the fact that somebody's saying it is just like so weird. And that's what we've, talked about a little bit with what's out there on social media and why the gurus are getting foreclosed upon. And the people who are wearing, ripped shorts and a t-shirt at a real estate investing meeting own like 30 multifamilies.
Right. It's kind of interesting. You're 100% right. And when you get lost in the social media, which I struggle with because I do watch it. I watch it, but I watch it with a careful eye of like, are you for real?
Yeah.
And then I watch the other side of it, where I'm watching some of the education that's being put out there, and I'm like, man, I know I could do better because I could give them the real deal. And then I don't have time, right? Because I'm up building my own empire right now. So if I had time to go and give everybody some advice for the negligible dollars, my little empire would be not surviving. And so I don't know. I think there is a huge statement to just being transparent and honest. And you touched on it when you said, I'm just honest. Like, it's so easy just to tell the same story every time if you're just honest. It's so easy.
You'd save so much time. Everybody's beating around the bush with all the BS. Right. When, we just get it done in 1 minute. I don't understand. I wanted to pivot back to multifamily, though, and just talk a little bit about geographically how you chose, because I think you said you were in 12 different states with multifamily. Am I right on that?
My portfolio of industrial and multifamily is in 12 states. We're in about 6 states with multifamily.
And did you say Southeast was the major focus for a lot of those?
So southeastern Wisconsin is our submarket. We have properties in Texas, we have properties in New York, we have properties in Ohio and Mississippi.
Oh, New York's interesting because it doesn't come up for a lot of people. I'm in New Jersey. I grew up in New York, and people are always like, "Is New York multi or is it industrial?"
Multi.
Yeah. See, that's interesting, though, because for me, I grew up, I owned countless properties in New York, never had a problem with tenants, never had a problem that it was, allegedly tenant friendly, but it gets a bad reputation where out there, the quote gurus are saying, don't ever invest in New York. How have you found it? And do you think that stuff's true in terms of landlord friendly, tenant friendly? Certainly it has its benefits in the courts if you have to do it.
I have a friend who's invested heavily in rent-controlled multifamily in New York, Manhattan. And he's going through the darndest and toughest of times right now, and his pain is real. And it's a real issue with government, and there's a real issue with rent control, and there's a real interest, there's a real issue for him. And they have $500 or $800 million of assets that are all non-performing and about to be taken from them, right?
Wow, yeah.
It's a real problem, okay? I have one deal in Albany, New York that I bought at an auction. It was a former Residence Inn. It's right next to the airport in Albany. It's called Skyview Terrace, or I forget what we call it right now. It's 100% occupied or 98% occupied.
Yeah.
It's I bought it. I refinanced it with the HUD loan. I have a 35-year HUD loan on the loan. I did that about 4 years ago. We have a 4% interest rate. It's cash flows every month for me positively. I have a third-party manager who's outstanding, Burns Management, shout out to them out of Saratoga and Albany. They're phenomenal. They've been really great partners of ours. We've pushed them. They've responded well. They've delivered. We're cash flow positive. We returned all of our syndicators dollars at the refinance, and we're doing incredibly well there. We did have 2 horror stories of COVID, and then 2 tenants that stayed longer than they needed to and fought us. And, at the end of the day, that person, right? So where does that set of humanity go? That family that I just kicked out of their home finally after 2 years. I don't want to sound disrespectful. I don't know them. I've never met them, but they're the future borrowers that are going to be in default, right? They're being raised to fail because the system allows them to be raised to fail, versus the other 98% that are paying their rent and doing what they're supposed to do in society and going to win. And so I don't know. There's probably some massive correlation to all of that together, but I will tell you, for our property in Albany, New York, it is a major winner for us. I would do it 100 times more if I could find the basis I did. And I'm really proud of that investment of ours.
Yeah, and there's also a reason why Rochester was ranked, at least the last few years, very, very high in the top markets to invest in. And it's in an allegedly, the most tenant-friendly state and very difficult. Manhattan, exactly what you're saying, though. They're going through a very, very tough time and things are coming hard against landlords. But yeah, that doesn't mean that's all of New York. And that's where I think if we go all the way back to the start of the conversation with the locality of real estate, the more you understand about your local market separates you from the news headlines that say like, hey, New York's a bad place to invest. It's like, well, not in Albany and Rochester and upstate. Like there's a lot of different things that you can do because they think New York means Manhattan, right?
That's right.
Yeah.
And to be honest with you, I go back to my friend who's going through this tough time, right? Which is going to end in massive loss, right? The only result is hundreds of millions of dollars of loss, right? Massive losses. And I go back to them and I'm like, well, was your business model flawed? And their model was essentially to buy rent control, get it off of rent control and improve the rents, right? Well, and then they had people that would take 5 years to get evicted because of Manhattan and the laws of eviction were very tenant friendly and put all that circus together. Who's the problem, right? Was the investment the problem? Was the investment thesis the problem? What was the problem? I don't really know. I don't know enough about it. But there's more to the story than just simply pointing over here and saying, New York, you're the problem, right? There has to be two to tango, and there has to be more there that's causing issues.
Yeah, I mean, this is obviously just spitballing, but I mean, if you're saying in any asset, like you're just saying, okay, rent control, and my whole thesis revolves around making money, we're going from rent control to not rent control. It's like new people who were in a forum and they're like, oh, it's cool, I'll just buy a 2-family and turn it into a 3-family. And you're like, no one there wants you to do that. And you're not allowed. You don't know about egress. You don't know anything. And I think that's the same prophecy. You create a kind of best case scenario and you're only looking at, well, if we turn all these over, yeah, but nobody wants you to do that because they need rent control for everyone who's lived there for 50 years, right?
I happen to agree with you. And I know that, we haven't talked about it, but there is a problem. There is a shortage of affordable housing in the country, right? And at the end of the day, New York did it. Otherwise, New York's doing it and managing it. And so is California, just because otherwise everyone would be pushed out, right? It'd be an elitist community across the whole place. And so I get it. And you have to do what you have to do. There's just probably a better way to do everything, but you put a mix of government and a mix of different politics together, and then you have a perfect recipe for the disasters that are pending.
Yeah, I don't know if you read Abundance by Derek Thompson and Ezra Klein. It just came out this year, but it talks a lot about the real estate boom and how the over-regulation caused a lot of the problems. If you just look at, like now we're like widespread NIMBYism. So you tell a town like, hey, we need, 2% low income so we can help people get into better neighborhoods, get into better schools. And this is literally happening in my town. And then in the Facebook forums, everyone's like, oh, that's great, but just, not in my backyard. Of course, that's
Right.
a NIMBYism. And you're like, what? They're like, come up with, it's going to create a lot of traffic. It's going to create a lot of traffic to have 13 low income in a 200 unit. Like, I mean, come on. Right. It's just like there's so much red tape.
That theory is the problem with maybe politics today, right? We want everything, but then when you say you have to do it, you're like, well, it wasn't really for me, right?
Yeah.
You want affordable housing? Well, your perception of affordable housing is crime, right? Your perception is litter, dirtiness. It's not really how it is. These people just want to live in an affordable place and better their lives. That's bad? I don't know. I don't think so.
Yeah, and I mean, the same thing goes to you're obviously a large-scale multifamily landlord. You've been involved in property management. And the overarching theme of the news is like landlords are slumlords and we're all the same. And it's like, I mean, I grew up with a dad who used to let people go 6 to 8 months without paying and then tell me to collect the rent because he was nice. And all of his friends who all at the same time were just investing in real estate, not because they wanted to be a hashtag real estate investor on the internet, because there was no internet. They were just trying to make extra money. They were just trying to do smart things like how you started. This looks like a good way to build a legacy and start. And you started. It's interesting how you progressed through everything. What was your favorite part of the ride? I mean, of course, you could say now, because obviously I have all the experience, but which part of all of these parts of real estate did you learn the most from?
Well, I'm going to answer that with two different brief statements. In January of 2010, came out of the heels of basically what we all called the Great Boom, which was, in my opinion, a fictitious Wall Street event that harmed a lot of people. But without getting into what your opinion was and mine was, at the end of the day, people were getting mortgages on homes that they could never afford because they didn't have to validate they could afford it because there was a boom going on. Okay, that's a bad recipe. But in January of 2010, I acquired 5 units in 1 month. They were 2 weeks apart. I bought 212 units and then I bought 20 units thereafter. And I paid a culmination of about $9,000 a door for these units, right? Yeah. And that to me was one of the aha moments where I looked at myself in the mirror. I was scared as I've ever been in my life. And I woke up and I straight faced it to everyone. I was the happiest guy in the world. And I knew I was going to be happy in 10 years. Yeah. And fast forward, I sold those assets 3 years ago and was very happy. We sold them for $47,000 a door. But the culmination of that work to get from $9,000 a door to $47,000 a door and all of that time just took a lot of discipline. And so my favorite moment that I recall was buying those units and reflecting on like, oh my God, what did you do? That was really the moment that that really, caught me to a point where I was, really proud of myself, but really knew like, hey, you did something serious. Now you got to pay. And so paying to me was I had to work extra hard and I loved it. And it was one of those amazing moments. In the lending business, I bootstrapped this business with $700,000 and I was dying. I was putting out $1.5 million a month and I was bringing in $1 million and I had a $500,000 delta every month to raise money. And in April of 2014, I kind of was like, I was at that point where I was like, what am I going to do? How do I grow this business? I'm in Milwaukee. And what did I do? I started calling people, right? Hey, you got to start talking. You got to be transparent. Yeah. So I called everybody I could in the world. And I ended up calling the CEO of a bank I knew that I was a client of. And I left the guy a message and I said, hey, my name is Scott. I have this business. I need some money. If you're interested, call me. 5 seconds later, he called me back and he's still that way today. Yeah. And fast forward, his family, not the bank, the family came to my office, ended up making a material investment into my business and really catapulted me to where we are today. Where we have, over $120 million of loans outstanding and we're growing and putting out loans and we're building an amazing team. And, so when you look at the minutia of growing and building, I pride myself on being the first one here every day and usually the last one to leave. My team works incredibly hard and it's not demanded, but it's insinuated. And they all ring the bell every day. And I'm just really proud of what we've built, right? It's not easy to build a business. It's not easy to be successful. It's not every day I'm like, oh, this is easy, right? I mean, there's days I want to go home and cry and there's no one to wipe the tears off. So I'm like, I'm not going to do that. I might as well go figure it out. And so you got to be resilient. You got to be disciplined. You got to know tomorrow's going to be a new day. And we continue to grind and push.
Yeah. Awesome, man. I really appreciate it. Is the best place for people to find both of your businesses, one at fstreet.com and then for the hard money at thehardmoneyco.com?
You nailed it. Did that both very well. Yeah. F Street, the way we kind of break it down is fstreet.com is our investor focused platform where we show our offerings and we talk about our deals. The Hard Money Co is our investor platform where people can borrow money from us. I call it our consumer platform, but we don't lend to consumers. We only lend to real estate investors. Yeah. So I don't like to confuse people, but F Street is where our investors make investments with us. And the Hard Money Co, thehardmoneyco.com is where people can apply for loans and we do real estate transactions off of that platform.
Yeah. Awesome. Wow. It's been a great show. I love the background and I like that you've been through all parts of the industry. I think it gave a lot of great advice for people out there to go take and put into their business. So I really appreciate you spending the time.
Yeah. Great show. I'm glad I could be 293 and I wish you continued success and appreciate hearing the stories of you and your father. And that's certainly a special time and a great story.
Yeah. All right. That was Scott Lurie. He's the founder of F Street. You got the websites right before that. I'm Jonathan Greene. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on episode 294 of Zen and the Art of Real Estate Investing. And it's Ari Rastegar of Rastegar Capital, commercial real estate investing for the story you're still writing. So no matter your story, whether you're preserving a legacy or building one, your commercial real estate investment strategy should honor what you've built and align with the future you're creating. We're future casting next episode with Ari. See you there.